After losing thousands of dollars and repeating the same mistakes again and again, I finally understood a painful truth. The market was never my enemy. The real problem was the way I was reading price and the way I was trying to understand how the market actually moves. And after watching traders make the same mistakes for years, I realized something important. Most American traders are not losing because they lack information. They are losing because they are looking at the market the wrong way. And in this video, I'm going to share 4 important lessons from Forex trading that completely change the way I look at the market. These 4 lessons will help you understand why price actually moves, what mistakes traders keep repeating, and how you can start reading the market in a much better way. Lesson 1. Price is never too high or too low. One of the biggest mistakes beginner traders make is assuming price has gone too far. They look at a chart and think, price has already moved so much, it has to come back. But that thinking is dangerous, because the market does not care what feels high or low to you. The market only cares about supply and demand. Let me explain. Imagine a currency pair is moving higher. Every candle represents a fight. Buyers are trying to push price upward. Sellers are trying to push price downward. If buyers are stronger, price continues rising. If sellers become stronger, price starts falling. Simple. But many traders ignore this. They see 5, 6, 7 green candles and immediately think, this has gone too high, I should short. But what they don't understand is, those green candles are showing you something. They are showing you that buyers are still in control. The market is literally telling you, there is still demand here. And instead of listening, traders fight against it. They try to predict the top. They try to catch the exact reversal. And this is where many traders lose money. Let's say price is moving upward in a strong trend. You see a resistance level. Price reaches that level. You think, this is resistance. Price has to fall. So you enter a short trade. But price breaks through. Why? Because that resistance level was not strong enough to stop buyers. The mistake was not the level. The mistake was assuming the level had power before price proved it. A level is just an area. Price action tells you if that area actually matters. Now let's understand why price keeps going higher. Imagine a stock or currency has been falling for months. Suddenly, buyers step in. They believe the price is valuable. They start buying. More buyers enter. Price starts moving higher. Other traders see the movement and think, maybe the trend has changed. They also enter. Now you have more buying pressure. Price moves even higher. This creates momentum. And momentum is why markets can move much further than beginners expect. The same thing happens in a downtrend. Price does not fall because it is too low. Price falls because sellers are stronger than buyers. A lot of beginners think, price already dropped so much, it can't go lower. But if sellers are still dominating, price can continue falling. The market doesn't reverse because of your opinion. It reverses when the order flow changes. So how do you fix this mistake? Stop asking, is price too high? Or, is price too low? Start asking, who is currently in control? Are buyers showing strength? Are sellers showing weakness? Is there actual evidence that momentum is changing? Because a reversal is not created by a feeling. A reversal is created by confirmation. For example, price reaches resistance. Most beginners immediately sell, but a professional trader waits. They watch. Do sellers actually appear? Do candles start rejecting? Does momentum slow down? Does structure break? If not, there is no reason to assume a reversal. The biggest mindset shift is this. A strong trend can continue much longer than you expect. Your job is not to predict where price should stop. Your job is to react when the market shows you it is ready. Lesson 2. Why breakouts don't always give pullbacks. One of the biggest mistakes traders make after a breakout is waiting for something that may never happen. They wait for the perfect pullback. They wait for price to come back to their level. They wait for the safe entry. And while they are waiting, the market moves without them. Now, before we continue, you need to understand something important. A breakout is not just a line being broken on a chart. A real breakout represents a change in the balance between buyers and sellers. It means something has changed. The side that was controlling the market before is losing power, and a new side is taking control. Let's break this down. Imagine price has been moving sideways for weeks. Buyers are trying to push higher. Sellers are trying to push lower. Neither side is strong enough, so price stays trapped inside a range. This is a battle. Every time price reaches the top of the range, sellers appear. Every time price reaches the bottom, buyers appear. But eventually, one side wins. If buyers become stronger, price breaks above resistance. That breakout is telling you buyers have absorbed the sellers. There is now more demand than supply. And when demand is greater than supply, price rises. Now here is where many traders make a mistake. They see the breakout. They know the market looks bullish, but they say, I'll wait for price to come back. Sometimes that works, but sometimes the pullback never happens. Why? Because there is no reason for sellers to push price back down. Think about it from a trader's perspective. Imagine you have been watching a currency pair fall for months. You finally see a strong reversal. Price breaks above a major level. You enter a buy trade. Now price starts moving higher. Why would you close your position immediately? You wouldn't. You entered because you believe the trend is changing, so you hold. Now imagine a seller. They see a strong, bullish breakout. Buyers are clearly in control. Why would they suddenly enter a short position against strong momentum? Most smart traders won't. So now you have existing buyers holding positions, new buyers entering, few sellers willing to fight the move. What happens? Price continues higher. This is why some breakouts create explosive moves. Because the market has only one direction. There is not enough selling pressure to create a pullback. The buyers are in control. But here's where traders get confused. They think, so should I buy every breakout? No. This is where many beginners make another mistake. A breakout is not automatically good. You need context. A breakout from an important level is different from a random breakout in the middle of nowhere. A strong breakout usually has certain signs. For example, a major support or resistance area, a clear market structure, strong candles showing momentum, a close beyond the level, and confirmation that buyers or sellers are actually controlling the market. Let's imagine a scenario. Price has been falling for a long time. Then it reaches a major weekly support zone. Buyers step in. Price creates higher highs and higher lows. A trend line breaks. Resistance breaks. A strong bullish candle closes above the level. This is not just a random move. This is a story. The sellers were in control, but buyers entered. They changed the market structure. That is what creates a meaningful breakout. Now let's talk about why traders miss these moves. Most traders have been trained to look for perfect entries. They want perfect support, perfect resistance, perfect candle, perfect pullback, perfect risk reward. But the market is not designed to give you perfect situations. Sometimes the best opportunities happen when the market is showing the strongest momentum. Another mistake traders make is thinking, if I miss the first move, I miss the trade forever. This creates emotional decisions. They watch price move. They feel regret. They jump in late. Then price finally pulls back, and they get trapped. The problem wasn't missing the trade. The problem was entering because of emotion. So what should you do? You have two choices. If the breakout is strong and the setup matches your strategy, you can participate with proper risk management. Or you can wait for a pullback. But you need to accept something. Sometimes waiting protects you. Sometimes waiting makes you miss the biggest move. A trader's job is not to catch every single move. A trader's job is to recognize high probability situations. Now let's understand the psychology behind momentum. When price starts moving strongly, it attracts attention. More traders notice it. More traders enter. News traders enter. Technical traders enter. Trend followers enter. This creates even more pressure in the same direction. This is why trends can accelerate. But remember, momentum does not last forever. Eventually, buyers become exhausted. Sellers start appearing. the market starts showing signs of weakness. That is when you look for reversal confirmation, not before. The lesson is simple. Do not assume every breakout will give you a second chance. Sometimes the market gives you one opportunity. And if you are always waiting for the perfect pullback, you may watch the best trades leave without you. Now let's move to the third lesson. Because even if you find a great setup, there is something many traders completely ignore, and that mistake can turn a good trade into a losing trade. That mistake is not checking the bigger picture through correlated pairs. Lesson 3. Always check correlations between currency pairs. One of the biggest differences between beginner traders and experienced traders is this. Beginners usually look at only one chart. Experienced traders understand that the market is connected. Every currency pair is telling a story. And sometimes another chart can reveal information that your current chart is hiding. This is why understanding correlations can completely change the way you analyze Forex. Let's say you find what looks like an amazing trade setup. You open your chart. You see a beautiful resistance level. Price comes back to that area. You see rejection candles. The structure looks perfect. Your mind immediately says, "This is it. This is my trade." But before entering, you need to ask one important question. What is the currency itself doing? Because a currency pair is made of two currencies fighting against each other. For example, EUR/USD is not just one thing. It is the euro versus the US dollar. GBP/USD is the pound versus the US dollar. USD/CHF is the US dollar versus the Swiss franc. If you only look at one pair, you may miss the bigger story. Let's imagine you are analyzing USD/CAD. You see price reaching resistance. You notice several rejection candles. Everything tells you the dollar is about to weaken. So you enter a short trade. But now imagine you check other USD-related pairs. You look at USD/CHF. You notice price is breaking higher. The structure is bullish. Buyers are aggressively pushing the dollar upward. Then you check EUR/USD. You notice it is falling strongly. The euro is getting weaker against the dollar. What does this tell you? The US dollar is showing strength. Now suddenly, your USD/CAD short trade does not look as strong. Why? Because you are trading against the bigger market pressure. This does not mean your trade cannot work. Markets are not guaranteed. A currency can still reverse. But you are now aware of the bigger picture, and that changes your decision-making. Think about it like this. Imagine you are watching one person in a crowd. You think you understand what is happening, but then you look around and see everyone else moving in the same direction. Now you have more information. Currency correlations work the same way. One chart gives you a small piece of the puzzle. Multiple related charts help you understand the full picture. Now let's talk about why beginners ignore this. Most beginners are focused on finding entries. They spend hours looking for the perfect indicator, the perfect pattern, the perfect candle, but they ignore market context. A good entry inside a bad environment can still fail. A great setup against strong momentum is much harder to trade. Let's look at another example. Imagine GBP/USD. You see a resistance level. Price reaches it. You see rejection. You think, perfect short opportunity. But you check the US dollar index. You notice the dollar is actually weakening. Now the reason behind your short trade becomes weaker. Because if the dollar is losing strength, GBP/USD has a better chance of moving higher. The chart alone did not show you the complete story. This is why professional traders think differently. They don't just ask, does my setup look good? They ask, does my setup make sense with the overall market? Because the strongest trades happen when multiple factors agree. But be careful. Correlation is not a magic prediction tool. You are not using another pair to guarantee your trade. You are using it to increase awareness. The goal is not certainty. The goal is making better decisions. Now, let's talk about something even more important. Sometimes traders see a perfect setup. They see support, they see resistance, they see patterns, they see confirmation. But then they notice one small problem, a level in front of their trade. And because of that one thing, they never enter. They watch the market move without them. This brings us to the fourth and final lesson. Lesson 4. There will always be something in the way of your trade. A lot of traders are searching for the perfect setup, a trade where everything is perfect. No resistance, no support, no possible problem. But that setup does not exist. Every trade will have something that makes you uncomfortable. And understanding this is a huge part of becoming a better trader. Imagine this. You analyze a currency pair. You see a strong weekly support level. Price comes into that area. You notice buyers stepping in. Then you see a reversal pattern. The market structure changes. Everything looks bullish. This looks like a great opportunity. But then you notice there is a small resistance level nearby. Your brain starts saying, what if price stops there? What if I lose? What if this level blocks the move? So you stay out. Then price breaks through and continues higher. You miss the trade. Why? Because you focused on one small obstacle instead of the bigger picture. The market is not a straight line. Price will always move through areas of uncertainty. Even the best trades have risk. The difference between experienced traders and beginners is not that experienced traders have no fear. The difference is they understand probability. They understand that one negative factor does not automatically cancel a good setup. A professional trader thinks, yes, there is a small resistance level here. But the trend is changing, the structure is broken, momentum is strong, buyers are showing control. The risk-reward makes sense, so this trade still has potential. The goal is not finding a perfect trade. The goal is finding a trade where the reasons to enter are stronger than the reasons to stay away. Final lesson. The market will always give you reasons to doubt your trade. One thing I learned after years of trading is this. The market will always give you a reason to hesitate. Even when you find a strong setup, even when your analysis makes sense, even when everything lines up,